Alrighty, man. Welcome. Welcome to the daily market wrap. This is the biggest charts in just under 30 minutes. I'm going to go ahead and share my screen here. Let's hop into TradingView. And let me just make sure that I add that to the stage. Let's start things off with commodities. So, man, look at gold go. And it really looks like it wants to make a test at that 5,000 US dollar level. So, one thing that is quite interesting here is the gap. So, let's just go ahead and check this out. Let's zoom into an hourly here on gold. And so, on the hourly, it's right here. So there's a gap there, but it looked as though there was also a gap on the daily, but I can't see it on the hourly. So if I'm looking on the daily, this is why I think there's a gap. You see that? You see that right there? It does look like there's a gap on the daily. And so all this means is that for 1 hour each day, every weekday, these futures contracts, they close. These markets close for an hour each day. And now, depending on the market that you're trading, the time can be different. But I think that the gold contract closes for 1 hour. This market closes for 1 hour immediately. I think it's an hour after the equity market close. So equities markets close at 4 p.m. Eastern Standard Time, and then the post market, the after hours trade starts immediately, but an hour after the cash market close, the futures markets close for 1 hour. And so the difference between the closing price on the daily candle right there for gold and the opening price of the after hour session before the regular market hours begin tomorrow morning, that's what gives you that gap right there. So I would kind of expect this to fill probably overnight. We get some type of a pullback in gold, maybe down to 49.15 to fill that gap. But hey, if it doesn't fill, if this gap doesn't fill and we get a gap and go out of gold, then this could be up at 5,100 quickly. Now, one of the reasons why I remain bullish on gold is because it seems to be tracking Japanese long end rates higher. So if I just scroll on down here and we take a look at JP30Y, that's this. JP30Y, this is the yield on Japanese 30-year JGB, so Japanese 30-year bonds, right? And so this, I think gold has been tracking this higher. And so we could actually show that here. If I just throw this, let me go ahead and bring that in. Let's just click on this plus button up top. And I want to go ahead and use the gold futures on a new price scale. There we go. And let me just see if I can just bring that into view a little bit. There we go, something like that. So it looks as though for the majority of the last, maybe call it 24 months, that gold futures, that gold has just been tracking long end rates straight up, Japanese long end yields straight up. So if I think that yields are likely to continue pushing higher, not just in Japan, but also in the United States, then I must also think that any pullback in gold is likely just a temporary buying opportunity. So if I take a look at gold, though, one thing that we have to keep in mind is this market is ridiculously overbought right now. So if we take a look at the RSI, this is the RSI on a daily. What's the reading? The reading is, look, a 79 is overbought. But here's the thing, markets can remain overbought for longer than you can remain solvent. So if you're looking at this thinking, okay, I'm going to get short because the RSI is going to be an overbought reading, well, this could stay overbought for the next several weeks. And if you zoom out from a daily to a weekly, and you take a look at this on the weekly, you get a similar reading of 78. But take a look at this on the monthly. Look at that reading. You're getting a reading of almost 95. I think that's the highest ever in the history of this contract. And we've got contract data going back to, what is that, 1976? Wow. So extremely overbought. But again, it's been in overbought territory since May of 2024. So remember, markets can remain overbought for well longer than you can remain solvent. So trying to step in front of this train and get short just simply because the monthly RSI is reading the highest level ever, I don't think that's a good enough reason to get short, especially since I know that gold has been just tracking long end rates higher for the last 2 years. It makes me think that since I don't believe long end rates are going to come down anytime soon, I think gold probably continues to push higher. But here's something to think about. If we take a look at maybe the 100-day moving average, let's see, when was the last time price was this extended from the 100-day? We had a significant extension here. That was back in April. That was a 23% extension from the 100-day moving average. And notice what happened. A couple of months later, we got a test of that 100-day moving average. How about this extension right here? Looks like about very, very similar. You see that? 23% extension. And we didn't even get a test of the 100-day after that extension corrected a little bit. Let's see, where are we now? Where are we now? So let's see. Oh, not quite 23%. So if it were to be 23% extended before we get some type of a dip, some type of a correction, well, hey, that would bring gold all the way up here to 51.25. So, hey, that seems like as good a target as any. 51.25 on gold looks like that could be the level where we get some type of correction, maybe back down towards the 100-day moving average. So I am long gold, and I'm actually trading it on Ostium out of my DeFi wallet. So if you want to learn more about that, just hop into the free DeFi University school community and take a look at some of the content that I published on that. Let's move on from gold to silver, SI. So I also got long silver earlier today. 98.41 is just ripping. So I got long silver because I thought that it was, I was willing to risk some capital to find out if my directional bias was right. I thought that silver would likely touch 100 like over the next couple of days, maybe by tomorrow. So I got long at like 96 or something like that, and hey, it's moving higher. Great. So let's just take a look at this. What type of reading do we get on the RSI here for silver? So on the daily, it is definitely in overbought territory. Let's zoom out to the weekly. And let's see, wow, okay, we're getting a reading of 87 on the weekly. But if we zoom out even further to a monthly, wow, we're getting a reading in the low 90s on the monthly. But look at that. This is actually not the all-time high reading. In fact, back in 1980, there was a higher reading. So here's one thing that's interesting about silver. If you price silver in USM2, like so, you end up with an inflation adjusted reading on silver. And silver has not quite yet eclipsed its 2011 inflation adjusted highs. So if it were to move up to those inflation adjusted highs, that would be an additional 28% from the current mark on the futures contract. So if we just hop in here just to the futures contract and we say, okay, well, maybe it's going to hop up, it's going to push up another like 28%. Where would that take the futures price? Maybe to 125? Hey, 125 seems like as reasonable a target as any. Quite difficult to price or to project where these assets can go when they go vertical like this. When you get these, these parabolas and things start to just enter price discovery, you start to have to use as many different pieces of data as you possibly can to figure out, hey, where can this asset go? So gold, silver, bullish on both of those in the immediate term. And let's take a look at copper. This is an interesting one because copper, and this is the monthly, so this is data going back all the way to 1989, 1988. So notice this level of resistance on copper. And I gotta say, I think that this one could really run if it breaks out above 610. So a breakout above $6.10 for copper, and then it just enters price discovery. And hey, if this thing is going to just run like the monetary metals have, well, it could be at $7 real quick. And so I got long copper futures over on Ostium also. And my first take profit is up here at 7. And since I got long earlier today, I've already got a profit on the position. So I just went ahead and rolled up my stops so that I can lock in a profit no matter what. And hey, I would be very, very happy with a 16% return. Multiply that by my leverage ratio of 3x. And, that's a 45, 50% trade. Depends on how long this takes to play out. But, that's what I've got my eyes on. And now that I've rolled up my stop, I can't lose on the downside. So very, very happy with copper, gold, and silver so far. Let's see here. Why don't we check in on BTC? And let's check in on a daily. So, Bitcoin has really just been range bound. And so this is the bottom of the range. So if you wanted to be a little bit more adventurous, you might get long Bitcoin here. But where would you set your take profit level? I think it probably makes sense not to try to play Bitcoin all the way up to the top of the range, which would be a move, something like that. Rather than trying to play for the top of the range, I think playing for the 200-day moving average, or this is actually the 100-day, I think playing for the 100-day makes more sense because notice the 100-day was resistance just a couple of days ago. So if the 100-day continues to hold as resistance, then a move on BTC, a bounce from what looks like support up towards the 100-day, you might find some resistance right here. So you might set, if you want to enter a long position here, you might set your take profit at like 94.7, something like that. And so, hey, there's something wrong with that trade. You set your stop down here at a break below this level of support, and you set your TP up here, maybe like 6% higher. That sounds decent to me. So Bitcoin, if you zoom out though, Bitcoin, when you zoom out, really, in my opinion anyway, it starts to look a little bit more bearish. So here is the 200-day moving average. And as technical analysts like to say, nothing good ever happens below the 200-day moving average. But for Bitcoin, it's not just about the 200-day. I think you really have to zoom out to the weekly. And on the weekly, this 200-week moving average starts to come into view. And in every previous Bitcoin bear market, it has checked in with the 200-week moving average. So whenever people say, oh, this time it's different, I just want to say, well, probably not. Like maybe this time it won't be any different than previous Bitcoin bear markets. So this bear flag pattern here, if I just go ahead and grab my brush tool and paint this in, there's the pole, there's the upsloping flag. If this bear flag breaks, then I wouldn't be surprised if the first target is 75K. And if that doesn't hold, then the second target would be the 200-week moving average, which would likely move higher. So it would probably be around like the mid 60s, something like that. And so that actually makes a lot of sense because, a pullback out of Bitcoin down to, let's say, 65K, that would be roughly a 50% correction. So a 50% correction would mark the shallowest bear market trough in Bitcoin history, which I think makes sense since we did not get a blow off top. We didn't get any type of real true euphoria in Bitcoin on the upside. I think that, those ETFs are really dampening volatility. And volatility works in both directions. Volatility works on the upside. It also works on the downside. So if we have a dampened or lowered level of Bitcoin volatility, that would explain why we never got that blow off top. And, and it would also explain why we may not get such a deep trough in the bear market. So my market bias for BTC remains to the downside. And all I'm doing now is waiting for a break of like 88K. So if we zoom in here to the daily, let's just take a look at this one more time. So, let me change that back. So this level of support, if 87 and a half breaks to the downside, then I would expect Bitcoin to continue to move lower to at least 80, but I really think it moves in a straight line to like 75. If this level breaks, I think that it would probably move down to 75. So that continues to be my bias. I'm a bit of a bear here for BTC. Let's take a look at ETH. So ETH did not make a high above those 3,400 dollar highs from the beginning of December. It put in a lower high. So take a look at what we've got here. If I grab that brush, here's the all-time high, which barely put in a double top, and then we've got a lower high, a lower high, a lower high, another lower high, another lower high. And let's take a look at the lows. A low, a lower low, a lower low, another lower low, and another lower low. The very definition of a downtrend is a series of lower highs and lower lows. So, of course, Ethereum is in a multi-month downtrend. And so that makes me think that any rally is an opportunity to get short. So if ETH and Bitcoin are able to bounce within their respective little channels that they've formed, well, then I think if it gets up to 3,350 or even 3,300, that would be a great opportunity to sell it. To sell ETH if it bounces to 3,300, I would probably start nibbling on the short side around 3,200. And remember, it's all about how much am I willing to risk to find out if I'm right. That's the crux of it. So I remain an ETH bear, and I would love to open a short position on a bounce up to 32 or 3,300. But if ETH doesn't bounce and just breaks down below that low from just the other day, actually, just from yesterday, if ETH breaks down below 2880, then I think it moves down to 2600. So that would be the target on the downside of a break below this recent immediate term low. And that would be, a pretty decent trade, to be completely honest. We're talking about 330 points. So 330 points on the downside, multiply that by some leverage, an 11% move multiplied by 3x leverage, and all of a sudden you're talking about a 35% trade. And if you start to use even a little bit more leverage, like 4x leverage, and ETH actually cooperates and you're right on direction and you use a tight stop, hey man, there's nothing wrong with 40 or 50%, getting short ETH on the downside over a short period of time. So that's basically the trade setup that I'm looking for ETH. Get short on a bounce or get short on a breakdown. But there's no way I could buy it here. I just can't, because all of these digital assets have just been trading so poorly, especially when you take a look at equities. So remember we were talking yesterday about this gap here. So that futures, that CME gap between the close on Friday and the open this Sunday, that gap has filled. So now that we've got the gap fill, are we going to see it roll over? Well, let's take a look at the NASDAQ. We got the gap fill, and it looks like we could be pushing a little bit higher. And if we take a look even at the Russell just doesn't care about the gap. The Russell filled the gap and pushed to fresh all-time highs. So the Russell has been the outperformer of the bunch. And if anyone was trading back in Trump's first term in 2016 and 2017, if you remember what the Russell did then, it feels very similar now. Watching the Russell just basically do nothing but go straight up. And that reminds me of what the Russell did back in 2016 and 2017 basically for 24 months, the Russell just did nothing but go straight up. And so I was always waiting for a correction to buy it. The correction never came. But here's why I think there could be a correction, a brewing in the Russell. The Russell is more interest rate sensitive items. But if we take a look here at yields, 10-year yields, so if yields are starting to flag off, so let's take a look at this. Take a look at this pattern here. So we've got the pull, and it looks like it could be just starting to form a bit of a flag and push. So if we're going to see yields actually continue to push higher, I think that would weigh on Russell 2000 items, possibly, just because they're more interest rate sensitive maybe than the S&P 500 names are. So speaking of yields, let's take a look at notes, because the note and the yield, they are inverse. And so I think it's a little bit easier to see how we might get a continued upside out of yields when you just take a look at this pattern here. So this is 10-year Treasury note futures, and notice resistance, 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 and below support, support. And then here's that 200-day moving average and trading well below the 200-day moving average now. So bounced off of resistance, broke the 200-day moving average, support quite a ways below. And if you draw a trend line here, also broke that trend line support. So it looks to me like notes will be headed down to check in with this level of support right here. And so what does that mean for yields? What it means is yields go up. And so where could yields find resistance? Well, right around right here. So 4.6% or so looks like it could be the next stop for 10-year yields. Now, let's go ahead and check in with bonds, the long end of the curve. So here we go, bonds. Bonds, this is 30-year Treasury bond futures, Chicago Board of Trade futures contracts here. So check out what we got. Resistance, resistance, and didn't even make it back up to that level of resistance before getting rejected, and didn't make it up there here either. And in fact, if we zoom in to this area, what do you guys notice? You see this head and shoulders pattern? Very clearly defined. And so that head and shoulders pattern, it looks like it may have actually already completed. So pattern completion, it looks like we've already tagged that pattern completion. So that head and shoulders pattern plus the fact that yields were, or I'm sorry, this is bonds. Bonds were unable to get back up to resistance, unlike notes. Notes were able to get back up to resistance. Bonds were not. So it looks like we could be about to check in with support all the way down here, which makes me think if we take a look at yields on the 30-year, that yields have more room to push higher, especially now that we've filled that gap. So here was the gap that was formed, and that gap has been filled. But this is kind of interesting. I see, let me go ahead and remove this here and this drawn object. So let's just go ahead and clean up this chart and get rid of that moving average. I want to throw down some trend lines here. So this, and you know what? I don't really see it any longer. This is not quite as well defined. I thought that there may have been some type of, megaphone pattern that was forming here. And these megaphone patterns, I mean, look, they can break in either direction. It really is, in the eye of the beholder, like how you draw this, which anchor points you use. But let's see, let me go ahead and remove that. At least there's some more clear resistance up top right here. And you know what? I guess you could say that maybe a little bit of support there. You see that? So it looks like if yields pull back just a little bit further, they'll run into some decent support. So I expect yields to continue to push higher. Another reason why I expect yields to push higher is fiscal dominance in the United States. So If bond vigilantes know that the Fed is effectively financing the government now, they may demand a higher rate of return in order to lend to the US government. So I would expect yields structurally have a bid underneath them. Let's take a look at the dollar, because if yields move higher, you would expect the dollar to rally. And, we really haven't seen that. As yields have consistently pushed higher over the last couple of months, we've just kind of seen the dollar tread water, So this pattern out of the dollar, just kind of treading water at long-term support, man, if the dollar breaks this support level, I think it moves a further 8 or 9% to the downside, maybe to 90. So, really, really important to watch the dollar, because if the dollar breaks down, well, that could mean that commodities have just another leg up. So, remember, we were talking about that silver inflation adjusted pattern and 125 as a target. Well, hey, if the dollar breaks down, then this thing could just rip again. And it would make this look like just the beginning of the parabola. So, that is just, my thoughts off the top of my head there. Um, let's go ahead and check in maybe with volatility, and then we can take a look at the move index. So remember, volatility is mean reverting. And all that means is if you throw down like a moving average here, and maybe not even the 200-day, maybe you throw down like a 100-day or something like that. So volatility, whenever it spikes, always tends to mean revert back down to some average level. Now, a spike in vol could mean that the mean moves higher. That's possible. But this move higher in volatility seems to have been driven by geopolitical uncertainty just over the last couple of weeks. And with that starting to get priced out, we're seeing that volatility mean revert. So we've got this big gap, this contract roll. Would not surprise me to see that gap fill and to see volatility futures move back down into low 17s, or maybe even all the way back down into like the 16s with the 16 handle, something like that. And so that would mean likely that the S&P and the Nasdaq have printed fresh all-time highs. Would not surprise me to see that. In fact, speaking of printing fresh all-time highs, let's take a look at some Mag 7 items in the last 2 minutes that we've got that are not printing fresh all-time highs. Microsoft. Let's take a look at Microsoft. So I was looking at this, we've been watching this, but I thought that on a break below, that was the high, and then we had a test of it. So this was the all-time high. We had that breakout. So this is a gap on earnings, gap and go, pushed above, printed fresh all-time highs, and then put in a false breakout. So when this level of what was resistance broke to the upside, it became support. Notice it held as support once, twice, 3 times, and then broke. And so I thought that when this level of support broke, that this gap would eventually fill. And so from the current spot price, from the current trading price there, it looks like we would still have to fill the gap 11 or maybe even 12% to the downside out of Microsoft. So I quite like the idea of getting short Microsoft if there's any type of retest. So if we get a retest on the underside of what is now resistance up here at like 465, that could be an interesting entry to trade it on the way down to fill this gap. So just an idea. And let's see, I'll check in with Apple before we end our call today. So AAPL, let me just go ahead and remove this 100-day. Let's throw down the 200-day. So I thought that a test of the 200-day could be in order if this level, notice very similar pattern. So Microsoft put in an all-time high, similar time frame, broke out, and then when it tested that level, it broke down below. Same thing with Apple. Here's the old all-time high. The breakout turns that what was resistance into support. We kind of clung to support here for a couple of sessions, broke down, and we've also got what looks like a head and shoulders pattern up here on AAPL, something like this. You see that there? So that would be the headline. the neckline, and we're basically at pattern completion right now. So if Apple can bounce, it might be an interesting short, but I would play it down to the 200 day, which is right here around 235. So I hope that this has been valuable for you guys. I hope that, going through some technical analysis here is always, just it's a lot of fun to go through these charts. I will see you guys tomorrow, and I hope that you have a great rest of your evening. Thanks so much for joining live.